Joining us now is Rick Rule from Rule Investment Media. How are you, sir?
Fine, Mark. Pleasure to be back with you.
Absolutely. So we did this 3 years ago at VRIC, just before the pandemic. Prior to that, we used to have Rick on all the time on BNN, and you still go on BNN. So it's great to catch up. And let's start with gold, obvious place to start. Do you think if you had to focus on one thing, is gold holding up well and doing well last year and then having a good run since November of last year? Is it primarily because of longer-term bond yields going down, the bond market sniffing out slower growth and decelerating inflation, profits recession, or is it more than that? Is it all money printing and the debt globally?
You asked me for one thing. I got to give you three things.
Okay, good.
First of all, I think the market response that we're seeing in gold is a lagged response. I think the circumstances were in place in 2020 and 2021 to move gold, but there was a lagged response. In terms of the factors that you talk about, the most important is negative real interest rate. You know, gold is really a savings and investment product. It competes against products like the U.S. bond market. The U.S. 10-year Treasury yields 3.5% in a currency that the U.S. government says is depreciating by 7% a year. That means if you buy a U.S. 10-year Treasury, you lose 3.5% of your purchasing power a year. Not very attractive.
No.
At the same time that you're getting penalized for owning the bond, the credit quality goes down. The U.S. government owes $32 trillion on balance sheet and $100 trillion net present value off balance sheet entitlements. And they add to the deficit by $2 trillion a year. If the credit's lousy and you get paid to own it, why would you own it? The third question, of course, is you described the long bond. As interest rates go up, the capitalized value of the distributions goes down. If you have a pension fund full of long bonds, you've lost 30% of principal in the last 12 months, whether you admit it or not. At the same time that your yield loses purchasing power after inflation. Classic case of bond disintermediation, the same we saw in the 1970s. Most of my competitors, mercifully, weren't cognizant in the 1970s, and so they don't notice things like this. But if you're old enough, you find that history repeats.
All right. Well, we know there's often a lot of hyperbole among gold bugs about the price. Oh, it's going to go to 5,000. I talked to Rob McEwen 10 years ago. He said that it may get there, but let's just deal with 2,000 to start with. Stay above that. And so do you have any sort of sense of in the environment over the next 12 months, how well can gold do you think?
I mean, I understand the question. I personally don't think in 12-month terms. I think in 4 or 5 year terms.
Okay.
And I think that unless and until the U.S. government has a balanced budget and until interest rates go positive in real terms, not nominal terms, then gold will do well. How well? I don't know. I know that gold rewards you relatively infrequently, but when it rewards you dramatically. I would describe for your listeners, my relationship with gold is that I've been a gold beneficiary for 40 years.
There you go. So you want to be positioned in gold and in certain companies. We're used to getting picked from you, and yep. you're happy to give them. So let's go large or small. Large cap would be what?
Are we limiting ourselves to gold or anything resources?
Preferably gold while we're on that.
I mean, the highest quality gold stock in the world is Franco-Nevada. It's not cheap, but it's sold off as a consequence of the difficulties in Panama. People who don't own gold stocks probably start with the best. The second best that I think you have to go to, you have to take some political risk, but I think you have to buy VRIC. If you want to go down the quality trail a little more, then you got to take a lot of political risk and buy yourself Endeavor. You have to be in places like West Africa that people can bell. I guess I'll leave it there.
Okay.
When you come all the way down into the juniors, what you find now is that they have been so out of favor for so long that the number of names that I could give you would exhaust your viewers. The caveat there is that you have to be psychologically prepared, first of all, for failure. You could make a mistake, and volatility, and you have to be patient. Most investors are none of those.
So no names in the junior space?
I would just tell people, portfolio in the juniors, looking probably at the royalty and streaming space, the safer part of it. If you want to game your name, I'm really attracted to the discoveries I'm seeing in Guyana right now. So those would be Reunion and G2.
Okay,
Attracted to that name. People who can take exploration risk and who can take political risk.
and we also know that you invested in Empress Royalty. You put, let's call it 7 figures into that.
Yeah, I like the whole viable part of the junior royalty space. So the generators like EMX Royalty, the people who generate their own, Altus Elemental. Certainly, I have a lot of time for the Endeavor Financial folks who are behind Empress Royalty.
Lastly, Rick, just shifting over to uranium, we know you closely follow the sector, you invest in the space, you were talking about next gen back in the day, and so I'm just wondering, when you look at uranium companies, are you looking at ones that you hope to make discoveries? Are you looking at the big guys, the chemicals? What about the Global Atomics that have advanced projects and close to production?
For myself, I positioned myself in the 2 majors, Cameco and Kazatomprom, 4 years ago. I don't need to buy any more of those. I'm full.
Where do you buy the Kazakhstan company?
Kazatomprom on the London Exchange.
Okay.
For people who don't know it, despite the fact that it's unpronounceable, it's the largest, most profitable, highest volume, best run uranium company on the planet. But you have to be comfortable having your money in Kazakhstan, which many people aren't.
Right.
Coming down the quality trail, I think you look at a company like General Atomic that just financed.
Global Atomic.
Global Atomic, I'm sorry. You hope that there's a post-financing hangover so that you can buy the stock at a 15 or 20% discount to the people who put the money in, and then you can watch the money go to work. The name of the game in the smaller companies is answering unanswered questions. You got to determine what the question is, you got to think about the probability that you get a yes answer, and think about the progression of time. So for people who are prepared to do the work, there is bigger money to be made in the Global Atomics of the world, in the fissions of the world. But don't do this if you're risk averse. Don't do this if you're psychologically unwilling to take volatility. And don't do this if you aren't willing to read the annual reports, read the proxies, do the work.
Sound advice, Rick. A bunch of names for us. You never disappoint, so thanks a lot.
Always a pleasure.
Okay, Rick Rule of Rule Investment Media.